Hey, quick question. Why would any country want its money to lose value? In 2025, US President Donald Trump shocked the world by slapping new tariffs on almost every major trading partner, especially China. By April, tariffs on some Chinese products crossed 200%. But tariffs weren't the only accusation flying around. Trump also claimed China was deliberately weakening its currency, the yuan, to cancel out those tariffs. And that raises a confusing question. If tariffs make imports expensive and strong currencies are supposed to be a sign of power, then why would a country intentionally make its own money weaker? Is China cheating? Is this manipulation? Or is this just how the global economy actually works? Today, we're breaking it all down. What is currency devaluation and manipulation? How is it different from depreciation? Why do governments do it? How do they actually pull it off? Is it fair? And is a weaker currency really bad? We'll even talk about the Plaza Accord, when the United States did the exact same thing. By the end of this video, you'll understand why currency wars happen and who really pays the price. What is currency devaluation and manipulation? Let's start with the basics. Currency devaluation is when a government intentionally lowers the value of its own currency. This is different from currency depreciation. Depreciation happens naturally, when an economy weakens, when investors lose confidence. When people start selling a currency on the open market, the value drops on its own. That's depreciation. Devaluation, on the other hand, is a policy choice. It's planned, it's controlled, and it's done on purpose. Now, there's another term you hear a lot: currency manipulation. Currency manipulation is when a government actively interferes with its exchange rate to influence trade, capital flows, or economic outcomes. But here's the tricky part. There is no clear global definition of currency manipulation. Many countries manage their currency to some degree, especially export-driven economies. That alone isn't illegal or unusual. It becomes controversial when a country pushes its currency down unnaturally, keeps it weak for a long time, isn't transparent about how it's doing it. That's when other countries cry foul and slap on the label, currency manipulator. But make no mistake, this label is often political, not purely economic. So now, the big question: why would any country want a weaker currency in the first place? Why countries want weaker currencies? At first, it sounds insane. Why weaken your own money? Doesn't that make everyone poorer? Surprisingly, not always. Reason 1: cheaper exports. This is the biggest reason countries devalue. Let's walk through a simple example. Imagine $1 equals 7 Chinese yuan. A Chinese factory sells a toy for 7 yuan. To an American buyer, that toy costs $1. Now the US adds a 30% tariff. Suddenly, that toy costs $1.30. Not so cheap anymore. American consumers start buying elsewhere. So what does China do? Instead of cutting wages or profits, China weakens its currency. Now, $1 equals 8 yuan. That same toy still costs 7 yuan, but now it converts to 88 cents. Even after the 30% tariff, it costs about $1.15. Boom! The toy is competitive again. No layoffs, no profit cuts, no headline announcements. And no, countries don't devalue overnight. They do it slowly, quietly, and carefully. Because when exports are worth hundreds of billions of dollars, even tiny currency moves matter. This is also why US exporters often complain that the dollar is too strong. A strong dollar makes American goods expensive overseas. Reason 2: invisible tariffs through imports. Here's something interesting. Tariffs make foreign goods more expensive to protect local businesses, but tariffs cause retaliation. Currency devaluation does something similar, without breaking trade rules. When a currency weakens, imports become more expensive. Local products suddenly look cheaper. It's like a hidden tariff. Slower, less aggressive, but harder to retaliate against. Of course, this can still cause inflation, just like tariffs do. Reason 3. Shrinking debt, the sneaky part. Imagine a government borrows $1 million from its own citizens in its own currency. Over time, the government prints more money. Prices rise, inflation kicks in. Years later, that same $1 million buys far less than before, but the government still repays only $1 million. In real terms, the debt became cheaper. This trick only works if the debt is in your own currency. If the debt is in foreign currency, like US dollars, then a weaker local currency makes the debt more expensive, not cheaper. That's why countries like Argentina suffer so badly during currency collapses. Speaking of protecting yourself from sneaky moves, let's talk about your personal data. Thousands of data broker websites quietly collect your name, phone number, home address, and browsing habits, often without your permission. Creepy, right? Manually removing your data means emailing dozens of companies, filling forms, and repeating the same process again and again. That's where Incogni comes in. You set it up once, and Incogni does the work for you. They contact data brokers, request deletion, and keep following up until your data is confirmed removed. Fully automated, zero hassle. You can try it risk-free for 30 days, and if you use my code EXPLAINS101, you'll get 60% off the annual plan. Links in the description, with a full money-back guarantee. How countries actually weaken their currency. So how do governments do this? They don't just edit numbers on a screen. Method 1. Cutting interest rates. This is done by the central bank, not the government. High interest rates attract foreign investors. To invest, they need the local currency. More demand, stronger currency. So what happens when rates are cut? Investors earn less. Some pull out their money, demand for the currency falls, and the currency weakens. Simple economics. Method 2. Printing money. Quantitative easing. The classic move. The central bank prints new money and uses it to buy government bonds. Banks now have more cash, they lend more, spending rises, and inflation kicks in. More money chasing the same goods means lower currency value. Method 3. Using foreign reserves. This is direct intervention. If a central bank sells its own currency in the forex market, supply rises, value falls. China does this a lot. Unlike the US dollar, the yuan doesn't fully float freely. China sets a daily target range. If the yuan falls too fast, China uses its $3 trillion in reserves to buy it back. Fast, but expensive. Is this fair or cheating? So, is this cheating? That depends who you ask. In 2019, the US officially labeled China a currency manipulator after the yuan crossed 7 per dollar. China denied it. No punishments followed, and the label was dropped in 2020. But here's the irony. In 1985, the US did the exact same thing. Facing massive trade deficits, the US pressured Japan, Germany, France, and the UK to weaken the dollar. They met at the Plaza Hotel in New York. The result was the Plaza Accord. Japan sold huge amounts of dollars. The yen skyrocketed. Japanese exports became expensive. Profits collapsed. To fight it, Japan cut rates and printed money, creating one of the biggest asset bubbles in history. When it popped in the 1990s, Japan entered its lost decades. After 2008, many countries weakened their currencies at the same time, triggering a global currency war. When everyone devalues, nobody wins. Is a weaker currency really bad? Not always, but it comes with real costs. Effect 1. Inflation. Imports get expensive. Prices rise. Countries dependent on imports suffer the most. Effect 2. Salaries lose power. Your paycheck stays the same but buys less. Effect 3. Inequality explodes. Asset owners win. wage earners fall behind, and if trust in a currency collapses, it becomes worthless. Conclusion: a weaker currency can boost exports, protect industries, and reduce debt, but it can also raise prices, crush wages, and deepen inequality. Is it cheating? Is it smart? Or is it survival? The truth is, it's all three, because in the global economy, it's not about strong or weak money, it's about who controls the currency and who ends up paying the price.